Oh, sorry.
She's just saying they recording the meeting, so I'm just.
You hit got it, and then you can X out of that.
This one, right?
Yep.
Can you guys hear me? Can you hear me now?
I can hear you, Brian.
Okay.
Hear me? Can you hear us?
Yep.
Can you hear us?
Yes.
Okay, I'm gonna mute you.
Uh, give everyone a few more minutes to straggle in here. So how you guys doing? Excited?
Good. Let's go to.
Mhm.
1, 2, 3, 4, 5, 6, 7, 8. Almost got everybody.
Well,
I'm not saying.
Okay. I think all the administrators are here now, from what I can see. Go ahead and get started because I have a 40-minute limit here on this initial one, and there's a lot to kind of get through. So I want to make sure we can get through it, and you guys can get on with your day. If it comes down to it, I have another one kind of set up after a short break to finish up any remaining bits that we didn't quite get to. But let's just get right into it. So due to time constraints, this PowerPoint isn't quite up to my normal standards for Razzle Dazzle, but you guys can prepare yourselves accordingly. Extra coffee, little Red Bull, whatever it is you need. HOTMA is massive. Much of it is quite definitive, but there is still quite a lot that needs to be clarified. I'll try to point out those things on the slides that are waiting on clarification. And some stuff we just won't really know how it's going to work until we start doing it. Also, for the entire first week that you guys will be starting this party, I'll be out of the office on the side of a mountain. So good luck. On to the next. HOTMA, Housing Opportunities Through Modernization Act. It came out in 2016. We're now in 2023. 7 years for them to kind of get their stuff together, and it doesn't even go in effect until January of 24. A lot of that was due to the fact that not only were all these rules put into law by Congress, HUD had to kind of implement and make all these things work with their programs, but HUD also has to update the track system, which is what kind of handles all of the data for everybody. When you send in these certifications and vouchers and stuff, it's the antiquated system that makes sure that everybody across the country gets paid for these things, for their subsidy. One can't work without the other, so part of that is fixing up some old system to be able to handle all of this new functionality and this new data sets that HOTMA is trying to put in. So once we get them both together, that's when it's going to work out here at the end of the year. We're expecting. It could kind of roll over a couple months into 2024 before we can actually do the switch, but I'll get more into that a little bit later. So here's a quick agenda broken up into the parts that and the flow that I kind of did the training for it on. First is the income and assets and what's changed with those, followed by the changes to all of the deductions, expenses and such. And then the last bit for HOTMA is a little bit more of the fun stuff that has to do with just random other changes that may or may not make your guys' job easier. The last couple short bits will be on the tracks implementation and some of the changes that come with that. Really just some little bits, little important parts that weren't already covered in the 3 HOTMA sections. Okay, first, fosters. The rules for fosters has changed quite a bit. Does anybody have fosters? I'm not gonna spend any time on it if nobody has any foster adults or children in their housing. I don't think it's very common. Okay, we'll go on from there. Students, they've changed as well. Not so much the rules as far as eligibility, but how the income is calculated. Now, this is just students of college, higher education kind of things. Does anybody have any of those that we need to go into this on? No? Well, okay. All right, the first big one, the changes to income. The definition is now literally all amounts that are not specifically excluded by regulation. There's no more examples or, lists of items in the handbook or the regulations to kind of give you an idea. It's really just anything that they say is not included. Of course, income also includes asset income from the last 12 months for any assets that are not also specifically excluded by regulation. So the Exhibit 5.1 in the handbook, that's going to get completely revamped at some point, and just show exclusions. And like I mentioned, the CFRs, which is where everything kind of starts, the federal regulations, that's going to be updated as well. Those will change right on January 1st, as soon as they go into effect. The handbook, 4350, where all these exhibits in the guidebook that we kind of go by for most things, is expected to be updated, but it could be quite some time. It's been almost 10 years now since the last update, and there's quite a lot of things in there already that are kind of outdated, but it is expected to be updated at some point. Until that time, we kind of got to go by the federal regulations or use, whatever other tools we can. I have created an income and exclusions form that I'll put into forms, which will give you a better idea of which incomes to include and exclude and how to handle them, what parts of them, etc. That should be already in there now, but I will continually be updating that thing as things get changed. Really, HUD will update those exclusions through Federal Register notices and publications and stuff. But yeah, that's really the best we can do for now. One of the nice things that has been added to the exclusions, though, is the veterans aid and attendance. Used to be an income that was a little bit more common. I don't know if you guys have it very much anymore, but there were a few veterans here and there that were getting that income. And even though it was intended for medical expenses and things like that, HUD still wanted us to include it as income, but now it is specifically excluded, which also means if they do get that, you don't include the money, but you also cannot include the medical expenses that are paid for by it, because it's technically like a reimbursement of medical expenses, and you can't include that portion. So if somebody does get aid and attendance, there's still a little bit of work that needs to be done to make sure that we're not giving them double credit for expenses or anything. I already mentioned the form, but so rural development is also affected by this and much of HOTMA because they cite a lot of HUD's rules and definitions, particularly for the determination of income and adjusted income, which includes all incomes and assets and pretty much expenses. The entire calculation of rent is very much a similar format. So I will also try to kind of note things on here as far as whether they affect rural development or not. Rural development hasn't really posted anything saying how they're going to implement some of these changes, when they're going to do it, any of that information. I don't really have anything for that other than knowing which things specifically cite HUD's things that have changed, and that's the best I can tell you for now. One of the terrible things that could result from this is that the dual health plan benefits that were a nightmare recently this year are not specifically excluded by anything so far. North Tampa hasn't said anything different as far as their clarification and determination that we can exclude it. So I'm not going to rock that boat, and we'll just keep going from there, and hopefully HUD will eventually release something about it once it becomes a little bit more common and prevalent. Even though everybody seems to have it at some of these buildings, it seems to be something that's flying under the radar for the most part. The next one here, determining annual income. How we calculate income at different recertification points. It used to be that everything is calculated by just taking your current income or whatever it is and annualizing that and using it to project the anticipated income for the next 12 months. Well, that's gone. For move-in, initials, and interims, that's still the case, and that's fine. You can still use the current income to anticipate the upcoming income for the next 12 months. But for annual recertifications, we have to determine the income for the previous 12-month period and use the amount as the family income for the AR, unless you're using streamlined income determination. Streamlining can greatly reduce the impact of this particular change. We'll get into streamlining kind of stuff a little bit later. Now, with this AR previous 12-month period thing, it's a little unclear. I'm still waiting on some clarification, specifically from North Tampa, which I asked them how they want us to do that last week. I haven't heard anything yet, but there are two exceptions. So when you're determining the income of a family for the previous 12-month period, you have to consider or use redeterminations of income on an IR occurring in the last 12 months. You must also, or the other exception is, you must make adjustments to reflect the current income if there was change in income in the previous 12-month period that was not accounted for in a redetermination of income. What I'm assuming this means is that even for changes less than the amount that would trigger an IR, it's something, the $200 a month flag, maybe their income only went up $150 4 months ago. They didn't need the IR, but in going back and looking at the 12-month period to determine what their income is, we wouldn't be able to include. I'm assuming we would have to stop at that point and take that income as the most recent current income. Again, I need a little bit more clarification, because it could also mean that we take from January's income up to that change for those 6 months, let's say, and then start including that change for the next 6 months, and then figure out what those last 12 months were the entire time. I'm not sure. I will be letting you guys know, because this is something that is really going to be needed to know here for the January research that are coming up. Really, we've just been taking what's on EIV and putting that in there, but this could mean taking EIV's amount from last year, or whatever change in between there. It's kind of, this is one of those non-definitive things. It's possible that rural development could be affected by this. I don't know. That one isn't exactly clear for them. Yeah, that's all I got for that one, though. So, sorry, were there questions? I will try to stop and let you guys ask questions if I ramble on a little bit too much here. There is a lot of information. Assets now. There's changes to the assets, inclusions and exclusions and all that fun stuff. The big one here is that we can say bye-bye to all of the retirement accounts. No more 401ks or IRAs, any of those types of things. Actual retirement accounts are now all retirement accounts as defined by the IRS are now excluded from assets, whether they're receiving income or not. Um, yeah, so we're not including the any sort of interest or the asset income from the retirement accounts either. Now, the retirement accounts, if they're receiving those periodic payments and required minimum distributions, those are still going to go into actual annual income as opposed to the asset income listing area on the 5.9. It's actual income. I have also created an asset exclusion and inclusion form to kind of help you guys figure out how to treat these various assets, what things aren't included, what incomes, how to count them, all that fun stuff. That's in forms now as well. They're both kind of just working. The income one and the assets one are just they're a work in progress. Rural development is affected by this again. That's part of how they calculate income, so these things will affect them as well. Does anybody have trust? Any of the residents have any trust accounts?
We do.
You do? Okay. Well, the same thing goes for the irrevocable trusts and trusts that are not under the control of a family member. They're excluded from assets and asset income, but the regular distribution is going to be included in annual income. Revocable trusts under the control of the family are included in assets, but their distributions are not included in their annual income. Only their actual returns or interest will be included in their asset income because they're listed in assets. It's a bit of a mess, and I don't expect you guys to remember those kinds of things, but that's why the form is there. Even in the handbook right now, the language for trusts being revocable and who has access, whether retirement funds, whether drawing funds off of them, all that stuff is kind of confusing to begin with. So I'm hoping the form will make it a little bit easier and quicker for you guys to figure out what to do. One other thing to note, an annuity is not a retirement account. It would just be a regular asset. But annuities, CDs, stocks, all those fun things, they're not retirement accounts either, but they can be part of a retirement account portfolio. So we still need to verify whether these things are, if they have a CD or a stock, the forms will have to kind of be updated to make sure that these are not part of an actual retirement account investment portfolio, so to speak. And this can be rather confusing because maybe some of our residents think, well, yeah, I have this CD or these stocks for my retirement. That's why they have the account. But if it's not an actual retirement account, then we have to include it. If it is a retirement account, boom, it's gone. We don't need to deal with any of that. And that change, the whole removing retirement accounts, is a big change that impacts multiple other changes that we'll discuss here coming up. Any questions with that? Okay. All right. Now's where things kind of start heating up. The $5,000 asset threshold for determining whether to calculate imputed income versus actual income for assets is now gone. In 2024, starting with HOTMA, the new threshold is $50,000. This asset threshold determines when we calculate and include imputed income. If it's over that threshold, we're going to calculate and impute any income for assets with unknown income. When when it's over, I'm sorry, when The $50,000 asset also determines when we can accept self-certification. If their assets are at the threshold or under, then we can accept self-certification, which pertains to streamlining, which again is something that we'll kind of get into a little bit later. So the term asset threshold is something I'm going to use quite a bit from here. Various terms for these new figures that I want to make sure that you guys are following as I use them. For 2024, it's the asset threshold is $50,000. The reason why I keep saying it's 2024 is because a lot of these new changes are able to be adjusted by HUD at least annually, based on inflation and other public consumer data, fun stuff like that. So that $50,000 threshold could go up in 2025 or any year after that. So I don't want to say the $50,000 threshold, but it's just the asset threshold, which right now is 50,000. In addition, that 0.06 passbook rate that we use to calculate imputed income is also subject to the annual inflation adjustments. Well, yeah, the RD doesn't do anything with self-certification or streamlining, but they are impacted by the asset calculations, imputing, and the passbook rate. So that again is a significant change to how their rents will be calculated at some point. Okay, calculating asset income, a little bit more here. Calculation requirements for actual and imputed income have changed. So previously, assets with a cash value under 5,000 would only include the actual income amounts for assets where you know the income. Once they exceeded that $5,000 amount, the asset threshold, you would then only include the greater of the actual income or the imputed income. And the imputed income is obviously the value of the asset with unknown income times the passbook rate of the 0.06%. Almost never got included, but now you are basing the entire asset value against that asset threshold. If it's under the 50,000, you're going to include the actual. If it's 50,001 or more, you're going to include all the actual asset incomes, and you're going to include the imputed income for all the assets that don't know it. You're basically including both once you get over that asset threshold. There is a difference, obviously, between known income and unknown income. When it's actual or known, you're able to verify an actual amount, the 2% on this CD, or even if it's 0% that you verified, that's still known as 0. Now, there are other assets and things where we don't know what it is. And sometimes we can't even get it on certain like stocks or various other investment accounts. They don't want to give us an actual amount. We would say it's unknown and be imputing that income if the total assets are over the $50,000 threshold. This should also include rural development, but I don't know how much of it. Now, let's kind of look at what it means here as far as what I was just talking about. So the first example there, they're under the threshold, the 50K threshold. So we're calculating and including each known asset income, which are the checking and the savings account. We verified that 3% and 4%, so we know what that income is over there, but there's a stock portfolio of 24,000 that we don't know. So it's marked as unknown, and since the total here with the 24,000 and the 21 is still under the threshold at 45, We don't have to do anything with the unknown stuff, and we just count the 351 actual known income along with the cash value there of 45. In example 2, the total is over $126,000. So you're well over the threshold. And we have 2 assets with unknown income there, the stock portfolio and the annuity. Obviously, the software is kind of going to do a lot of this stuff for you, but you still need to kind of understand the process. And so for the assets with known income, you're going to manually calculate those incomes for each individual one and then add them together. For the assets with unknown income, once you're over that threshold, you add all of the unknown incomes together. So in this one, we have 111,000, and then you impute the total of the unknown. So that gets $67 at the current passbook rate, and then you add that to the actual of 79, and you get $146 of asset income on top of their 126 some odd $1,000 in assets. Does that make sense to everybody?
Yeah, Brian. So what you're saying is that when you've got known income, like you've got land here and it says 0,
Right.
that's not going to get imputed. That 0 is considered actual income.
Yeah, because we know it's not earning income.
Where before we would impute.
Yeah.
Okay, so now with the asset unknown income, you've got stocks, portfolios, annuities. What constitutes unknown income? Aren't we still supposed to try to determine what the
Yeah.
income is?
Yeah. If you can get them to give you an amount, I mean, it's on the form and we're requesting a percentage, but with stocks, that stuff changes every day. And even though we want to just get whatever it is at that particular moment, they may not give that to us. And now we can kind of make it not be such a fight trying to go back and forth, getting a hold of somebody and nailing them down on a number, or trying to get some paperwork and find a percentage somewhere on their 20-page quarterly statement. We can just
How hard do we have to try to get it? Or do we just
have
take what
to have that first attempt, really? I mean, I don't, there's no real definition for how many times.
So we can't use upfront verification. We still have to send it to the
Well, if you have something from them, you know, if the tenant brings in a statement or whatever, yeah, you can use that. And if it shows it on there, then use that too.
But what if it doesn't show it on there? Then we have to go to the source and try to get the income.
No. If you're going to use that form, then just use that.
Okay.
Let's try and,
Question.
yeah.
You indicated that if residents have less than $50,000 in assets, they'll be able to self-certify.
Yeah.
Does that mean that we don't have to do third-party verifications on assets if it's less than $50,000 for the household?
Essentially, yes, but that's something I will get into towards the end of all of this.
Okay,
That's all part of the streamlining stuff.
thanks.
Yeah. Yeah, okay. All right. Personal property. There's non-necessary and necessary personal property. Necessary personal property are things like cars and electronics, appliances, furniture, jewelry, all that fun stuff. Non-necessary are I wrote that down wrong. Necessary personal property, non-necessary personal property is still included in assets. Necessary is not, but there is a threshold now for when we will include the non-necessary personal property, which is that $50,000 asset threshold. If they disclose that they have non-necessary personal property that is has a combined total value of under $50,000, they don't have to include it. It's just excluded from the assets. But if they have a bunch of things like coin collections and copyrights, recreational vehicles, whatever non-necessary personal property is, it totals over 50,000, then we have to include it in assets. And it pushes them over the threshold, obviously. So we would, and it does not actually have an income, so we would be imputing that income for those assets. But we would be imputing the total. We're not listing 17 different things. They can just say we got 50 something thousand in personal property, which is kind of shown here on this next little example. Kind of took the stuff from before and just stacked on a little bit of non-necessary personal property, which exceeds the $50,000 threshold by, so it's 52,000. So it has to be reported on here and adds to the asset value and adds to the total for which we will impute that unknown income from. Okay, here's a big one. Now this one is, and the next couple are only Section 8. So, and just Section 8, not PRAC or 2 or 2.8. So John Knox, Lakeland, Tampa Villas, Bradenton Villas, Heritage, Sunshine Villas and Annex, and Lake East. Gone are the days of no limits to the total or type of assets. Those are gone. Starting with the